There's this a very specific, almost seasonal anxiety that hits. I feel it right around the end of January. We're deep enough into 2026 that the New Year's sparkle is, it's gone.
Reality sets in.
Reality sets in, the decorations are down, and people start looking at their financial resolutions. Maybe they're planning to help a family member or, pay a tuition bill. And then the shadow creeps in.
The paperwork shadow.
Exactly, the paperwork shadow. It's that lurking fear, that generosity that has a hidden price tag. I was reading some listener emails, and it's just amazing how paralyzed people get by this.
Right.
They're convinced that if they write a check to their brother or help their parents with a bill, some red light starts flashing on a desk at the IRS.
It's classic audit anxiety. There's this deep-seated belief that moving money between family or friends even is just inherently a taxable event.
Which is exactly why we need to do this deep dive today. I've been going through the stack of documents for this, the 2026 federal gift and estate tax guidelines, inflation tables, all of it. And honestly, the gap between what the rules actually say
And what people think they say.
it is massive. The fear is mostly unfounded, but you really have to know how to read the map.
And the map has been drawn very specifically for this year. The lines are distinct.
So here's the mission. We're going to map out the safe zones for 2026. We need to figure out exactly how much capital you can move without a single form. I want to get into why the inflation adjustments didn't really move the needle on the annual limit. That was a surprise to me. And we need to drill down on the huge difference between reporting a gift and paying taxes on it.
They are worlds apart.
Because reading these statutes, they seem like two completely different universes.
They are, and frankly, that's the headline here. The tax code, for all its reputation, is actually structured to allow for, significant wealth transfer without the government taking a cut, provided you follow the flowchart.
Okay, let's start at the very bottom of that flowchart then, the everyday stuff. I feel like we have to clear the air for anyone who just bought their friend a birthday present.
Right.
If I buy my best friend a really expensive dinner for a promotion or a nice suit for a job interview,
Why?
have I just entered the tax zone?
You're safe. The IRS generally does not care about your appetizers or your fashion advice.
Good to know.
Yeah.
But there is a number where they do start caring. The sources all highlight the annual gift tax exclusion. I was looking at the tables for 2026, and I have to admit, I did a double take.
Because the number didn't change.
Exactly. The number is $19,000, which, it's a healthy amount, don't get me wrong.
Sure.
But looking back at the 2025 data, it was also $19,000. I just assumed with inflation everywhere, this would tick up to maybe 20. How the whole hold?
It all comes down to the rounding rules. The IRS formula for these adjustments, it requires the result to be rounded down to the nearest thousand. So even though there was inflation, the math just didn't quite tip the scale far enough to jump to that next increment. It got close, but not enough to click over. So for 2026, we hold steady at $19,000.
So we don't get a cost of living adjustment for our generosity this year. We're working with the same cap. But let's clarify what that $19,000 actually is. Because the biggest misconception, and I see this everywhere, is people think it's a total budget for the giver.
Oh, that's the most common error we see. It limits people for no reason.
Like, I have $19,000 total to give away this year.
No.
It's per recipient. That's the key phrase in the code, right?
Right. It's a per person per year boundary. It defines the relationship between you and one other individual. So you can give $19,000 to your son.
Okay.
You can give another $19,000 to your daughter. You can give $19,000 to your neighbor, your barista.
Or your favorite podcast expert.
I was hoping you'd pick up on that, but seriously, yes.
The scale of this is what's so interesting. So theoretically, if you had the cash, let's say you just sold a company, you could stand in a stadium and hand $19,000 to every single person in the front row, and the IRS wouldn't require a single piece of paper.
Theoretically, yes. As long as no single person gets $19,001 from you, those transactions are, for all intents and purposes, invisible to the federal tax system.
Wow.
It's what we call an administrative convenience threshold. The IRS just doesn't want to process the paperwork for gifts smaller than that.
Which really reframes the whole thing. It isn't a limit on how much you can give. It's a limit on concentration.
That's a perfect way to put it. It's a concentration cap. And that cap gets a lot higher if you're married.
The marriage multiplier.
Yeah.
The split gift. I saw this in the note. This feels like the critical tool for parents trying to help adult kids.
It is the first lever you pull. Because the IRS sees each spouse as a separate person with their own $19,000 exclusion. So if you and your spouse want to help your child with a down payment,
You don't just have $19,000.
you have $38,000. You write a check for 19. Your spouse writes a check for 19. That's 38 grand of tax-free, reporting-free cash moving from one household to another.
And just to take it a step further, because the sources map this out, if the adult child is married, you can double it again
Exactly.
because their spouse is another recipient.
That's it. You give to the child, your partner gives to the child, then you give to the child's spouse, and your partner does the same. Now you've got 4 checks flying around.
That's $76,000.
$76,000 moved instantly.
That is a serious amount of money. That is a solid down payment in most of the country. And nobody had to file anything. It's just done.
It is clean. And that's why we always tell people, before you get into complicated trusts or anything, just look at the simple math of the annual exclusion. It usually solves the problem.
However, even 76 grand doesn't solve every problem, especially when we get to the two big ones, education and healthcare.
The 2 biggest line items and the ones that inflate the fastest, for sure.
The sources talk about these hidden exemptions, or they call them unlimited buckets. This is where the details really, really matter, because there's a huge catch to this rule. You can't just write a check to your niece for college and write tuition in the memo line.
No, that is the classic mistake. If you write the check to your niece, even if she promises to spend it on school, even if she shows you the receipt, the IRS counts that against your $19,000 limit.
Okay, so what's the move?
The exemption is tied to the method of payment. The rule is direct payment.
Direct to the institution.
Exactly. The check has to be made out to the university. The wire transfer goes straight to the billing department. If you do that, the ceiling just disappears. You could pay $50,000, $60,000, $80,000 a year for tuition, and it does not count as a gift. It sits completely outside the tax system.
But we need to be precise here, because I saw a distinction that I think could trip people up. When the IRS says tuition, they mean tuition.
Yes, this is crucial. The unlimited exclusion covers enrollment fees and tuition. It generally does not cover room and board, meal plans, textbooks.
That's a huge distinction. So if I pay the full bill to the college, and that bill includes $15,000 for dorm and food,
that $15,000 portion is technically a gift to the student. It would count against your $19,000 annual exclusion.
Got it.
The tuition part is exempt, but the living expenses are not.
So you have to be surgical. The strategy would be pay the tuition directly to the registrar, and then maybe use your $19,000 annual cash gift to cover the living expenses.
That is the perfect stacking strategy. You combine the unlimited direct payment with the capped cash gift. Maximize the transfer.
And this same logic applies to the medical exemption.
It works exactly the same way. Direct payment. You have to pay the provider, the hospital, the surgeon, the orthodontist directly.
What about the definition of medical? Is it broad?
It's pretty broad, yeah. Diagnosis, cure, treatment, prevention. Basically anything a doctor orders. And critically, and this is a big one, it covers health insurance premiums.
That is huge. I feel like that is buried in the fine print.
It is so often overlooked. If you have an elderly parent or a child who's aged out of your plan, you can pay their health insurance premiums directly to the insurance company. That is an unlimited tax-free transfer.
So just to play that back, make sure I've got it. I could pay $20,000 a year for my mother's long-term care insurance directly to the provider.
Yep.
Pay $50,000 for surgery directly to the hospital.
Mm-hmm.
And still give her a check for $19,000 for groceries. And I haven't triggered a single tax form.
You are completely in the clear.
That really changes the calculus.
Yeah.
I think people hoard money for these emergencies because they think transferring it is this huge, complicated mess.
When the system is basically begging you to pay these providers directly, it's a policy choice. They want to encourage this.
Okay, so we've covered the safe zone, the 19K. We've covered the magic loophole, the direct payments. But now we have to go out into the deep water.
The so-called danger zone.
What happens when you just want to give someone cash and it's more than $19,000? Let's say I want to give my brother $50,000 to start a business. I'm $31,000 over the limit.
Right.
Do I get a bill for 40% of that money?
This is the most pervasive myth in personal finance. And the answer is nothing financial happens. You do not owe a penny of tax.
So I'm over the limit.
You're over the reporting threshold. You are not over the tax threshold.
Okay, walk us through the mechanics of this, because reporting sounds scary. It implies you've done something wrong.
It does sound ominous, but you have to think of it like a scoreboard. You give your brother $50,000, you're $31,000 over the annual allowance. So all you do is file IRS Form 709.
A separate return.
Yep. filed alongside your normal taxes. And Form 709 is basically just a scorecard update. You're telling the IRS, hey, I used up $31,000 of my lifetime coupon.
The lifetime coupon. Okay, this brings us to the big bucket, the lifetime estate and gift tax exemption. This is the number that really, truly matters.
This is the number. And for 2026, the news is significant because of what didn't happen.
Right. Looking at the legislative history and the sources, there was a cliff we were supposed to fall off of.
Yes. The tax laws that doubled these exemptions back in 2017, they were scheduled to sunset, to expire. We were looking at a scenario where the exemption was going to get cut in half.
That would have been a massive shock to the system.
Huge. But according to the legislative updates we have, that drop was prevented, the cliff was bridged. So instead of dropping, the exemption actually rose with inflation.
So what is the magic number for 2026?
The lifetime exemption is now $15 million per individual.
15 million.
Per person.
So going back to my brother and the 50,000, I file Form 709. The IRS sees I'm 31,000 over. They just subtract 31,000 from my $15 million bucket.
Exactly. You now have $14,969,000 left in your bucket. You pay zero tax.
It is almost hard to wrap your head around that unless you are in the ultra-high net worth category. Gift tax is.
Yeah.
It's basically a myth. It's a boogeyman.
It is. For 99.9% of the population, Form 709 is purely informational. It's just administrative. You will likely never, ever deplete that $15 million bucket.
And since we established married couples double everything.
A married couple in 2026 can shield $30 million from federal transfer taxes.
$30 million. That creates a massive amount of runway. But it does raise a strategic question. If the bucket is that big, why do we even care about the $19,000 annual limit? Why bother with the direct payments?
That's a great question. The reason is that the $15 million, it's finite. It seems infinite, but that bucket is also your estate tax exemption.
So whatever I use up while I'm alive isn't there to protect my assets when I die.
Exactly. It's a unified credit. If you give away $10 million while you're alive, you only have $5 million left to protect your estate at death. So smart planning means preserving that big bucket. You don't want to waste it on things that could have been free.
Which brings us back to that hierarchy we talked about.
A hierarchy of giving, right.
So let's synthesize this for someone listening right now with their 2026 ledger. Step 1 is always the annual exclusion.
Always. It is. Use it or lose it. If you don't give the $19,000 this year, you can't roll it over. It's the easiest, cleanest way to move wealth.
Step 2, the direct payments.
Medical and tuition. Never, ever waste your precious lifetime exemption on a tuition bill that could have been tax-free. Write the check to the school.
And step 3 is, don't fear the form.
Do not fear the form. If you need to help a child buy a home and it costs $100,000, just do it. File the Form 709, you are just chipping a tiny little flake off a $15 million iceberg.
It's interesting, this conversation started with fear of the IRS. But looking at these rules, the government is essentially encouraging us to give money away while we're alive.
They are, and from a psychological standpoint, that's often the better move anyway. People hold on to wealth until they die to avoid complications, but then they miss the joy of seeing the money actually work.
Right, you don't get to see your kid buy the house if you wait until the will is read.
Exactly. And with a $15 million safety net, the tax code is basically giving you permission to be generous now.
There is one lingering thought I have, though. We talked about how this $15 million limit was saved by legislation. It was supposed to drop, but Congress stepped in.
The legislative save.
It just reminds us that these numbers, they aren't gravity, they aren't physics, they're policy.
They're written in pencil, not ink.
Right. And that brings up kind of a provocative thought for our listeners. We are sitting here in 2026 with a historic $15 million exemption. The window is wide open. But political winds shift.
They always do.
Administrations change. Economic priorities pivot.
We've seen it happen before. Exemptions go up, exemptions go down. It's cyclical.
So if you're sitting on the sidelines waiting for the perfect time, or thinking, oh, I'll deal with this in 10 years, maybe the fact that the window is this wide right now is the signal.
There's a very strong argument for use it while you have it. We know the rules for 2026. We can read the guidelines. We have no idea what the rules for 2030 will be.
That's the takeaway. Don't let the fear of paperwork stop you from doing the right thing for your family, especially when the law is so clearly on your side.
Well said.
Let's do a quick rapid-fire recap of the numbers just to lock them in. If someone takes away 4 numbers from this deep dive, what are they?
Sure. Number one, $19,000. The amount you can give to anyone, anywhere, tax-free, no paperwork.
Okay.
Number two, $38,000. What a married couple can give to any one person. Number three, $15 million. The amount you can give away over your lifetime before you pay a single dime of gift tax.
And the last one?
And number four, zero. The amount of tax you pay on tuition or medical bills if you write the check directly to the provider.
Generosity without anxiety. That's the goal for 2026.
And a little bit of paperwork isn't the end of the world.
Thanks for diving deep with us. Hopefully this clears the path for some of those financial resolutions.
Always a pleasure.
We'll catch you on the next deep dive. Keep asking questions.